Welcome investors to one more monthly and financial year ending interaction with Canara Robeco. What a financial year it was. We moved from extreme enthusiasm to a lot of despondency to some correction lately that we have seen. So it was a fairly volatile year whereby we saw market moving up, then moving down almost 20% point to point on broader market side, and then again Nifty moving up 6, 7, 8% in last month. Clearly, this volatility has been caused by several factors, and some of them we will touch upon during the interaction over next 10-15 minutes. Let us start with the global aspects first, because while we have certain earning challenges or growth challenges domestically, they are cyclical. What market is more worried about currently is what is happening globally, and those global aspects are so complex that hazarding a guess in terms of how it is likely to play out for any stakeholder, whether it is investors, businessmen, and individual countries, is so difficult that this uncertainty is actually causing what you are seeing in market. The predominantly the uncertainty related to how the supply chains and value chain which was developed over last 30 years, whereby US predominantly was a consumer and the rest of the world was predominantly a supplier, is actually has come under question because of the tariff policies that US has put forth. These tariff policies clearly, if implemented, even half of what they are saying clearly actually leads to a situation whereby there is a lot of uncertainty for any stakeholder to invest, and that's what you are experiencing right now. It clearly has a negative growth connotation, because if there is uncertainty, everybody will keep lower inventory, everybody will keep probably throughout the supply chain the inventory corrections will happen, and tariffs will also lead to little bit of an inflation upward bias in US. So that's the situation where we are, whereby tariff related uncertainty is hampering at the margin growth on one side, whereas it is actually not leaving enough deceleration in inflation for Fed to cut aggressively. That's the scenario in which we are. Now this scenario clearly means that you are in a global environment where there is a negative growth impulse, or there is at best there is a neutral growth impulse, most likely a negative growth impulse emanating from US and its policies, both around geopolitics as well as, more importantly, around tariffs. Now of course it has one silver lining. Now how it plays out, that only time will tell, but it has one silver lining, which is how the capital allocators globally will look at the globe. Till 3 months back, there was this consensus that US will actually post-election will start growing better, driven by the new administration's policy. The growth upgrade will happen, the earnings upgrade will happen, and thus the capital was flowing back to US from all emerging markets, Europe, etc. Now, with this thesis being turned upside down, now you are seeing that the capital will search for yield outside US, given the kind of policies that US is implementing, whereby all emerging markets, Europe, is likely to be net beneficiaries. Now how it happens, only time will tell, and it will evolve over a period of time. But what we are already seeing is that the negative inflows that were there in previous 2-3 months have turned net positive towards emerging markets and also towards Europe. Because in Europe, the one thing which seems to be clearly changing is the incremental investment towards defense and infrastructure creation. Suddenly, with the status of NATO and Ukraine-Russia war and the positioning that US has taken, it has dawned on the entire Europe that they need to spend very aggressively, both in terms of defense as well as infrastructure creation. So for the first time, you are seeing effective fiscal expansion in Europe, which will lead to, at least initially, growth, and that's where you are seeing that there is a good positive inflows that have gone into Europe, apart from some of the other emerging markets over last 1 month. So that's the global context. Not so great. Clearly uncertainty prevails. We will further get clarity on this post of reciprocal tariffs, but clearly this uncertainty means negative growth impulse, particularly emanating from US. It also means that the US inflation, or in general manufacturing inflation, for a lot of supply chain will actually be pushed up rather than pushed down, which is negative for the US interest rate cuts, which only means that the US interest rate cuts might get delayed or might be lower than what was anticipated. And in that environment, the capital allocators have to actually choose the among the emerging markets and rest of the developed world, which is where I think we are at this point in time. So that's the global context. Coming to domestic context, I think domestic context has remained as it is. We have fairly strong macro, both external and internal macro. As we have been alluding to, that most of the macro factors, be it the government balance sheet, be it the private balance sheet, be it the bank balance sheets, largely remain almost pristine. The only challenge has been basically the growth, and the growth is decelerating. And predominant reason for growth moderation or deceleration over last 3 quarters has been government's moderation of capital expenditure. So if you look at last 3-4 years, predominant driver for the earnings growth or above average earnings growth, particularly last 6-8 quarters before financial year 25, was predominantly driven by the government's capital expenditure accelerating at 17-18% CAGR. The rest of the stakeholders, whether it is credit growth, has been kind of moderating for a few quarters. The private capex remain 8-10%, but not accelerating given where the consumption is. So the growth deceleration is predominantly because one of the pillar which was actually accelerating the growth has actually moderated or is moderating, driven by the fiscal consolidation needs of the government. Do we believe that this is a cyclical slowdown? Our sense is this is a cyclical slowdown because none of the macro indicators, global or external or internal, are a risk at this point in time. Only risk is to growth. So at some point in time, this cyclical base should come in effect, and private capex, credit growth should actually start accelerating. Even the consumption part of the economy, as well as the export part of the economy, from where they are, should only look up over next 3, 4, 5 quarters. So that's our view. Cyclically, probably moderation ongoing, but structurally, you should expect basically some of these other stakeholders apart from central state governments to come to fore in terms of basically supporting that growth. That's where we are. The rest of the macro indicators, be it current account deficit, which is roughly about 1%, is under control. Inflation has actually surprised negatively throughout financial year 26. You are likely to have probably closer to 4% inflation, which means expect anywhere between 25 to 75 basis point of interest rate cuts starting from next month or two. So clearly monetary lever is becoming available to RBI to cut interest rates because your inflation is undershooting as a consequence of the kind of demand that is there, as well as the improvement in the basically supply side in the economy. So that's where the domestic macro is. As far as earnings are concerned, we are again will be going into the last quarterly earnings growth. As of now, the earnings estimate consensus are not out, but roughly the implied numbers are in high single digit growth. So earnings growth after actually being 25% in financial year 24, financial year 25 has been subdued. It is just actually rebasing itself as a consequence of, as we said, the government expenditure moderation and some of the global uncertainties, which is actually weighing on some of the sectors like IT and other exporting sectors. So that's where we are in terms of valuation. Of course, valuations have come to a stage where the large cap valuations at about 19 times 1 year forward for Nifty consensus are largely in line with historical. So market might consolidate as a consequence of the cyclical slowdown or cyclical moderation in growth that you are seeing. But as a starting valuation, it looks fairly attractive if one were to take 3-5 year view based on the last 10 years averages. As far as broader market is concerned, we are relatively still more circumspect there, given the kind of earnings cuts that have happened, and given valuations are in the context of historical valuations. Mid cap, small cap still remain about 10-15% higher valuation as compared to their own historical valuations. More importantly, we would look for basically the earnings trigger to get constructive on that part of the market. You need stronger earnings growth. While the earnings growth is likely to move into double digit for Nifty, we are as of now not very sure how it is likely to move for broader market. So we look for basically earnings recovery as one of the trigger for turning relatively more constructive on the broader part of the market. As of now, as we said, we expect consolidation in all parts of the market, but gradually as you go into 26 and 27, financial year 26 and 27, the earnings are likely to recover to low double digit, driven by predominantly factors like some of the segments of the economy which were really doing bad, which is One of them was credit growth had come down, which we expect to move up with the interest rate cuts. With interest rate cuts, some of the domestic cyclical consumption is likely to kind of improve from the base where it is. Even on export side, we expect at some point in time these uncertainties related to tariffs will wane during financial year. So as a combination of monetary loosening as well as liquidity benefits, as a consequence of private sector capex remaining 8 to 10%, government capex anyways is around 8 to 10%, and at the margin improvement in basically consumption and exports, we expect the earnings to move back to double digit, and that should actually start rolling over in the market as well post this consolidation phase. Are we worried in any way about the structural factors? We don't see any of the structural worry in terms of the balance sheets across the basically spectrum, whether it is government balance sheet, private sector balance sheets, or bank balance sheets. In terms of our portfolio positioning over last 6-8 months, gradually the portfolio positioning has moved more barbell between the domestic cyclicals on one side and consumption exports on the other side. So gradually over last 6 months, 8 months, the portfolios have added part of the consumption, part of the exporters, and away from some of the domestic cyclicals like industrials and auto. While the industrials auto still, part of industrials auto still continues to do well, that portion of the portfolio has come off over a period of time. IT has also come off over last 3 months, and it has gone into the other sectors, including some of the defensive as well as consumption, as well as pharma, telecom, etc. So as of now, as portfolio stands, broadly the portfolio is overweight on large lenders, which is large banks, large NBFCs, select insurance companies, select market capital plays, select industrials, pharma, telecom, aviation, hospitals, and hotels. These are the spaces where portfolios are largely generically overweight. Portfolios are underweight on commodities and energy. So that's roughly how the portfolio is positioned for financial year 26, whereby it is more barbell than a significant cyclical overweight that was there in financial year 24 and 25, first half of 25, towards the domestic cyclicals. We expect financial year 26 to be a gradual recovery year in earnings, and thus a gradual recovery year in the market as well. That's largely for this month and financial year. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.